Understanding technical analysis is one basic thing that anyone who wants to trade any financial market has to understand, be it crypto, the stock market, or even the forex market. Technical analysis is that thing that gives you the ability to be able to predict the market movement within a specific period of time. So with technical analysis, you would be able to understand where the market is headed to, where the market is currently at, what the market is actually going to do next. Technical analysis is one important concept that all traders in the world must understand, and that is why you see some people, when they analyze the crypto, the forex, or the stock market, and when they tell you that oil is going to crash, or Bitcoin is going to get into the bull market, or Ethereum price is going to fall, or GBP USD is going to go bullish, what they rely on before they could be able to do this is what we call technical analysis. Technical analysis is a broad topic that you should understand and you should know about, and that is why in this video I have brought to you a very extensive lesson where I will be teaching you technical analysis from beginning till an advanced level. In this video I will be teaching you the basic of technical analysis, candlestick charts, candlestick pattern, support and resistance, market structure, entries and exits, trend lines, and how you can combine all these concepts to form a strategy that's going to allow you to have an edge in the market and be able to trade profitably. If you are going to get this value for absolutely free, I will implore you to hit the like button so that it's going to help with the YouTube algorithm, and a lot of people will benefit from this. In this video, you'll be learning the following concept. I'll put the timestamp somewhere around this video so that you can see and you'll be able to watch some parts, and once you understand some part, you can always skip to the next or just go straight to the part you would like to learn. So we're learning candlestick charts, market structure, support and resistance, candlestick patterns, chart patterns, trend lines, entries and exits. So getting into the video, let's start with what is technical analysis. Technical analysis is a technique or a kind of knowledge that allows you to use previous price action of whatever has happened in a particular asset you are analyzing to determine what is actually going to happen next. Talk of candlestick charts, price action, indicators, all these are concepts in technical analysis that you use to analyze the market. And what does it mean? It means that you look at what has happened in the market in the past. What has happened in the market in the past actually gives you a clue of what is likely going to happen in the future. And how do you know this? You know this by the concept we will be talking about in this video. So the first concept we're talking about is a candlestick chart, because candlestick chart is the basic of everything you need to learn about technical analysis. Candlestick chart is actually the basic because every chart you see, whether in the crypto market, the stock market, or even the forex market, are based on candlesticks. You see people analyzing the market and you see that you have the chart that looks like a graph, and in this chart every component you have there is a candlestick. So what is candlestick and how do you understand the concept of candlestick chart? So let's jump right into my screen so that I will show you what candlestick chart is and how to identify them. Let's get right into it. When you're talking about technical analysis is actually a broad topic that you need to treat one after the other, but if you want to treat technical analysis, the first thing you need to talk about is the candlestick and the anatomy of candlestick, or what we call the basis of candlestick. You will see that when you see traders analyzing the market, you see something like this, which is a chart, and you see that this chart consists of things we call the candle. So everything you see on this chart, each of them is a candle, and that is why we call this candle. That's why we call this kind of chart a candlestick chart. So we have different kind of charts in technical analysis. There are a lot of chart. We have the line chart. You can see this is a line chart. We have the candlestick chart, which is what everybody, majority of the traders use, and which is what is the commonest one in the market. And the reason why candlestick chart is used is because these candles have each of these candles have a meaning. It has a message that it passes to you as a trader, and you as a trader or as an analyst, you need to understand the concept of this candle and what does it mean. What does the candle portray generally, and what does each of the candles say whenever you see them on the chart? So when traders analyze this chart, they look at this chart, and with the candles they see, they are able to tell that this market is likely going to go up or down. So these charts that you see comprises of candles that are formed together to form a chart. But before you can understand what a chart says, you need to understand what is a candle and what are the components of a candle and what does each candle signify. So that is why I feel that it's important that you understand the anatomy of candlestick and you understand what each candlestick means or what it portrays. So for a candle, any candle that you have in the crypto or the forex markets, there are majorly two types of candle. We have the bullish candle and we have the bearish candle. The bullish candle is a candle that tells us that the market is going up. So just this, that's the first point you have to note. Any candle that tells you that the market is moving from down to the upside is a bullish candle. And any market that tells you that the price is moving from up to the downside, that's a simple and a layman language that I'm using. So a bullish candle simply means that the market opens at a very low part of the chart and it moves up and it closes at an upper part of the chart. And a bearish candle means that the market is started or the market opened at a very high place on your chart, and within that movement of the candle, it moved downside and closed at a very low point on the chart. So that is the first concept you have to understand about the candle. So you have a bullish candle and you have a bearish candle. Also, most of the time, the bullish candle is represented with a green color and the bearish candle is represented with a red color. Even though some people use some other colors, you can use any other color that suits you. But majorly, when you see a bullish candle in a chart, it is usually a green candle telling you that within this movement, price went up. And whenever you see a bearish candle, it's usually a red candle telling you that this means that the price dropped within that movement. So apart from this thing, before I go into the details of the open, close, high and low, there is something we call the time frame. Time frame is a very important concept whenever you're analyzing the market, because candlesticks simply talk about the movement of price within a particular time frame. That's what the candlestick is representing, the movement of a price of an asset that you're analyzing within a particular time frame. And for this lesson, I'll be analyzing the Bitcoin market, and we'll be looking at the candles on the Bitcoin USD market. So let's say, for example, the market opened here at $50,000, for example, and it came down a little bit. Then it went up high and closed here at $55,000, for an example. There must be a time frame that is being measured, which means this candle must have a time frame, a particular time that you are talking about. Also, this candle also will have a particular time frame that you are talking about. So if you say, okay, Bitcoin moved from $50,000 to $55,000 on this candle, we'll ask you on what time frame. Is it within 1 hour or within a week, or the movement? I'm talking about the movement now. Was the movement within an hour or within a week or within a month or within just a minute or within 30 minutes? That is why we have a time frame on every chart you are analyzing. So for this chart, for example, we have a lot of time frame. You can see we have 12 months time frame, which means that for every candle, if you switch to a 12 months chart, for every candle you see on that chart, each candle represents the movement of that asset you're analyzing within 12 months. Same with 6 months. It means each candle represents the movement within 6 months. For a month candle, I just switched to a monthly candle. It means each candle represents the movement of price within a month. For a weekly candle, it means each candle represents the movement of the price within a week. If you use a daily time frame, it means each candle represents 1 day of price movement. If you use 4 hours, it means each candle represents 4 hours of price movement. If you use 1 hour, so we have different time frame. So time frame means that a time which is specific to the chart you are looking at, and each candle on that chart represents the movement of the price within that time. So let's go to the monthly, for example. So this monthly time frame like this, you will see that this candle that that I where I place my cursor, this candle says Monday 1st of January 2024, which means this candle represents the movement of Bitcoin in this month of January 2024. Then the previous candle, the candle before it says Friday 1st of December 2023, which means this is a monthly candle, and this candle represents the movement of Bitcoin within the month of December 2023. And if you look at it, you will see that it started here in December 2023 and it closed here on the 31st of December 2023. Yes. And the following candle, which is Wednesday 1st of November 2023, means this candle represents the movement of Bitcoin in the whole month of November 2023. So if you switch to the weekly time frame, you see that it's going to be different. Let me delete this. Let me just delete this drawing. So if you look at it, you see that this candle is representing the movement from Monday, January 15, 2024, and today is Thursday, January 18. So it means this candle is still running because it is a weekly candle. It's representing the movement of Bitcoin in this week that we are currently. The previous candle, you see, it says Monday, 8th of January. So that means that candle started from Monday, 8th of January, and it ended on Sunday, 14th of January. So each candle on the weekly time frame represents the movement in a week. How do you use this candle? How do you know whether you are going to analyze on the monthly, weekly, or daily time frame? I will explain that one in the coming video. So make sure you look at the videos I will post after this. And also, please note that this video is actually one of the series in my crypto course where it has a playlist actually, and the playlist is a full course on cryptocurrency where you'll be learning how to trade the cryptocurrency market from the scratch. So do ensure that you watch other videos as you watch this one too. So this is a weekly chart telling you that this chart is telling you that each candle you have on this chart represents the movement of Bitcoin within 1 week. If you're not analyzing Bitcoin, you're analyzing something else, it is the same concept. So if you switch to daily time frame, it means each candle represents the movement in a day. You see, this is today's candle. This is a daily time frame. Thursday, 18th of January. This is yesterday's candle. Where is the 17th of January? This is Tuesday, 16th of January. This is Monday. So each candle here represents the movement within a day. So any candle you see in the market, there must be a time frame attached to it because the candle is representing the movement of the price from one place to another. So let's get back to anatomy of the candlestick and talk about the components or the parts of the candlestick that we have. So each candle has 4 major parts: the open price, the close price, the highest point, and the lowest point. So that is why you have open, close, high, and low. So I said earlier that this is a bullish candle, which means that the price moved upward in this movement. So let's look at the page. It means that the price movement in this candle opened here. Let's say this place is $50,000, for example. Then it came down a little bit and created a lowest point. So when you got to this place, started going up again, went high to this place, that is the highest point it reached. And then it came down a little bit and closed. Even though it did not close as the highest point, but it still closed much higher than where it opened. That is why we call it a bullish candle. A bullish candle is any candle that the open is lower than the close. The open is down and the close is much up, higher than it. So that is what we call a bullish candle. So this is the point where the price opened, then it came down, then it started going up again, reached this high point, came down a little bit and closed here. So those are the 4 components of a candlestick. The open price, which is where the market opened for that particular candle on that time frame. Then it moved down to this low. This is the lowest point it reached during this price movement in that time frame we are analyzing. Then it went up to this high, which means the highest point the price reached before closing at this point. And this close is the point at which that time frame or that candle closed. That is a bullish candle. So let's go on our chart and look at something similar. So if you go on this Bitcoin chart let's go on a weekly time frame. You see this is a weekly time frame. The candles are bigger. this particular candle, which started on Monday 23rd of October 2023, is a bullish candle. So you can see that. I'm trying to zoom this up. So this particular candle that my cursor is touching, so you can see that the movement started at this point, 30,044. That is the opening price of that candle. So let's just put it as open. So that's the opening price of that candle. Let's give it a black color. Cool. So that is the opening price, this particular point where the price opened. Let me put this up a little bit. So when the price opened here, it went down a little bit to 29,910. So we'll call that one the low, because that's the lowest point price reached before going up. So let's just label that as the low of the candle. That's the low, right? So let's give that a different color blue. Fine. That is the low of the candle, this particular place where the candle touched before going up. Then the market now started moving up during this week, because we are looking at the weekly time frame, and this candle represents the movement within 1 week. So market now started going up. It reached this point. So that is the high of the candle. That's the highest point it reached. So we call this place the high. This particular point, you can see it, the high. So let's just label it as the high of the candle. This point, high, right? Okay, let's use another color for this. You may be wondering which application am I using? This is what we call Trading View application. It is what we use to analyze the crypto market. If you want to learn how to use this application, I made a video on how to use Trading View on my channel. I'll link it in the description below, so you can check the description box and look at the video that's going to teach you how you can use this application called Trading View. So this is the high. Let's get back to what we are saying. This is the high of the candle. You can see it here, the highest point the candle reached. Then where did it close? When the candle reach this place, it's now closed at this place. You will see that particular point where the candle closed is the exact place where the following candle opened. It closed here. The candle closed here. That is the close. So it is that close that the next candle will open. So let's label it as the close of the candle. The close. Yeah. Let's give it a different color. Fine. Nice. Perfect. So this is the opening of the candle. This is the low. Opening means the point at which the price opened. The price started within that movement. Then low means the lowest point it went to. So it went down a little bit before moving up. Then it reached this top. It went down again and closed at here. So the reason why it goes up and down, as things we'll discuss in later videos. So make sure you subscribe and stick around for other videos. So that is that about the bullish candle. So let's get back to our diagram. This is the open, the close, the high, and the low. And I hope you have seen that and you have understood that in the chart I just showed you. So if you understand something from that, make sure you tell me in the comment section. Also, we have a bearish candle, which is telling us the price is declining or the price is dropping. So now let's go for a bearish candle. The open will be up because it's telling us that the price is going down. So if something is going down, it definitely is going to start from someone higher and stop at someone very lower. So this is where the price opened for a bearish candle. Price opens here, went up a little bit, then it started dropping. It dropped to this point, which is the low, and then went up a little bit to close here. So that is the meaning of a bearish candle. A bearish candle simply means that price started up. The bullish people or the bullish traders tried to push it up, but they could not. They didn't have enough strength to push it up. Then they started dropping, dropped to this place and closed here. So this is the high, this is the low. The high and the low is always the same. What is the difference between the bullish and the bearish candle is the open and the close. For the bullish candle, the open is just at the bottom and the close is up. And for a bearish candle, the open is at the top and the close is at the bottom. It's just a simple concept of price going up and the concept of price coming down. So let's go into our chart and see what a bearish candle looks like. So cool. You see we have a lot of bearish candle here, red candles. So let's choose one of them and use an example. Let's choose this particular candle and let me zoom this in. Okay, cool. Let's use this particular candle. You will see that this particular candle is a bearish candle, telling us that price started moving from this place, which is the open, 26,495 per Bitcoin, dollar per Bitcoin. Then it went up a little bit to 26,845. Then it started dropping, drop to this lowest point, 17,000 within that week. You see that, you always understand that you use a time frame to analyze the market. Then it dropped to 17,703 within that week, and it closed at 20,000 for that week. So this candle represents the movement of Bitcoin within that week that started on Monday, 13th of June 2022. You see that the date is always down. Whenever I place my cursor on any candle, it is going to show the date on the downside. So let's look at this candle. Where is the opening price? The opening price is here because this is where the price started. And I've told you that opening price is always where the previous candle closed. This is the previous candle. It came down and closed here. Then this is where the next candle starts. So this is the opening of this candle, this particular point. Let me drag it up a little bit. Perfect. So let's label it as the open. Perfect. Then when it opened here, it went up a little bit and touched this particular point at $27,040 per Bitcoin. So that is the high of the candle. That is the highest point it touched. We call it the high. Let's give it a different color. Alright, so that is the high. Let me just trying to move it a little bit. Cool. Then when it touched that highest point, it started coming down and touched this point, which is the low. This place is the low, the lowest point on the chart. Let's label it as the low of the candle. Nice. Then it now came up a little bit and closed at this place. So this place, we call it the close. So if you compare this candle to the one I showed you, the picture I showed you, the close, you will see that it is basically the same thing. The candles may be longer, they may be bigger, but it's pretty much the same concept. So this is basically the anatomy of candlestick, and this is basic of everything you want to learn in technical analysis. So make sure, if you want to learn more about technical analysis, make sure you subscribe to my channel and like this video. And also, if you have any topic in crypto and forex that you would like me to talk about on this channel, ensure you put it in the comment section, and I'm definitely going to look at it and treat that as fast as possible. Having understood the concept of candlestick chart and having understood the anatomy of candlestick, now let's jump into the concept of market structure, because you have to understand what structure your market is before you can make any decision about trading. So before you can make any decision about trading, what you have to understand is market structure. What is market structure all about? Market structure is simply a concept telling you where is the market going. Is the market going in an uptrend, which simply means the market is going up? Is the market going in a downtrend, which simply is telling you the market is going down, or the market is going sideways? So when you understand market structure, you'll be able to decide, do I want to get into a long trade? Do I want to buy? Or do I want to get into a short trade? Do I want to sell? Or do I want to wait or trade the highs and the lows of the range? All these concepts would be explained when I jump right into my screen right now to tell you and explain to you what market structure is and how you can use them to trade the crypto, the forex, or the stock market. Market structure, I haven't known the concept of candlestick charts and I haven't understood what a candlestick, what an anatomy of candlestick is, and what each candlestick contains, it is important we talk about market structure, because market structure is what is going to guide you on what to do in the market, and whether you are going to take long trade or whether you are going to take a short trade in the market. So market structure is basically what you are going to use to understand all these concepts. So market structure simply does the following things. It tells you what to do in the market, whether you are going to buy or sell, and it also tells you when to buy or when to sell, and other important things like that. So we have different kind of market structure in the cryptocurrency market or the forex market. We have the first market structure we have is uptrend. We have an uptrend. We have a downtrend. We have a downtrend. We have a downtrend market structure. And we have the sideways trend, or what we call the range or sideways trend. So it's either we call it sideways trend or trend. These are the three market structures that we have in the crypto or the forex market. So when you analyze the market, you have to look at your chart first. What particular trend are we in the market? So if it's an uptrend, you start looking for buying opportunities. If you're a downtrend, you look for selling opportunities. And if you're in the range, you as a beginner trader, you don't trade the range. Even though if you are an expert trader, you can trade a range, you can either buy or sell in a range. But as a beginner trader, it's advisable that you don't trade the range of the market, because it can be a little bit technical or tactical, and you might end up losing your money as a beginner trader if you are trading the range of the market. So as a trader, if you have an uptrend simply means you have a series of higher highs and higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So if you have a market where you have series of higher highs and higher lows, you say you are in an uptrend. And you say you are in a downtrend in a market when you have series of lower highs and lower lows, lower highs and lower lows. So let me just sketch it for you so you can see that. So when you have something like this in the market, you say you are in a downtrend. You are in a downtrend because obviously the market is moving down. But the reason why the market moves this way is that if you look, the market does not just move like this. If the market is going up, it does not just move like that or like this. The market will not move like this. It always moves in the choppy direction. Goes up, it always goes up, come back a little bit, then move again, then come back, then move again, then come back. That is how the market moves. And if the market wants to come down, then the market start doing like this, something like this, come down, move up a little bit, then again, move up a little bit. So that is how the market basically works. So that is why we say that we have different kind of market structure. So let me go back to what I have in an uptrend market structure. Uptrend simply means that the market is moving to the upside. The market is going up. And there is this saying that we say that you have to follow the trend. You have to be a friend of the trend. So as a trader, you have to be a friend of the trend, which means that if the market is trending up, you should find an opportunity to buy because the market is going up. And if the market is coming down, you should find an opportunity to sell because the market is going up. So if the market is an uptrend, you have to look for buying opportunities. And if the market is in a downtrend, you have to look for selling opportunities, which is shorting trade opportunities. And if the market is in the range, as a beginner trader, I would advise that you stay out of the range market until you get to a stage where you can trade the ranging market. So I said that in an uptrend, we have a series of higher highs and higher lows. So let me explain the concept of higher highs and higher lows. So if you look at this sketch that I just put down, this market, this is where the trend starts here. For example, it starts here, then the market moves up a little bit to create a high. Then it comes down. again to create a higher low. We call this higher low because when the market comes to this low is higher than the previous low. This is the previous low. This place is where the market started, is a low, right? Market, that particular place is a low, right? Then let me just set this. I'm trying to make this more visible. Cool. So this particular place is a low. This is where the market started, right? Then the market moved up, come down again, but it could not come back to this previous place. That's why we call it a higher low. Then it goes up again to a place that is higher than the previous high. That's why we call it a higher high. So you can just label this one a higher low, higher low, higher low, HL. Yes, and we call this one a higher high, higher high, HH. So this one is another higher low. This place is another higher low. This is another higher high. This particular point is another higher high. The reason why we call it a higher high is because this high is higher than the previous high. This one is higher than the previous high. We call this one higher low because this low is higher than the previous low. This another place is higher than the previous low. So it basically means that when the market goes up, it pulls down a little bit. But because it does not go back to the former place, the former low, we call it a higher low. Then it goes up again, come back, we call another higher low. Higher high, higher low. Higher high, higher low. Higher high, higher low. So that is what we call an uptrend. An uptrend is a market, is a situation whereby the market has series of higher highs and higher lows. So now, this market will continue to be in an uptrend. So far it continues making a series of higher highs and higher lows. Until maybe it now happens that this market stops going up and starts coming down. Once it beats this place, this particular point, and starts trending down again, we say there is something we call change of character. We say the market is now in a downtrend. You can see that it's now in a downtrend according to the sketch I have. So if the market is going up, fine, it's an uptrend. But if the uptrend now stops going up and starts trending down and breaks a previous higher high and start going down, we say there is a change of character. It means that the character, which is the higher high, which is the uptrend, has changed to a downtrend. That is what that simply means. So let's go to a downtrend. This downtrend is where the market starts at this point. In a downtrend, the market starts up here, then start going down. The market starts going down. So when the market started going down, it came down here to create a low. Then it came up, create a high. This high is not up to this particular point where the market started. So we'll call this one lower high. We call this place a lower high because it is a high, but the high is lower than the previous low. Then when the market comes down again, we can say it created a new lower low. So let me just label it for you. This is a lower high. Let me just label this. This is a lower high. And this particular point is a lower low. This particular point is a lower low. This point again is a lower high. Lower high. And I'll explain soonest. This point again is a lower low. And that's how it continues. So this place is a lower high because the market come down and tried to go up again, but it could not push beyond this point before it started going down again to create a lower low. The lower low means this low is lower than the previous low. So don't confuse this lower high with higher low. Higher low is in an uptrend and lower high is in a downtrend. So higher low means a high that is higher than the previous low, and a lower high means a low that is lower than the previous high. So in an uptrend, you have higher highs and higher lows, and in the downtrend, you have lower highs and lower lows. So it means that the market comes down, push up again, comes down again, push up a little bit, comes down, push up. So anytime it pushes up and it cannot beat the previous high, then we call it a lower high, a lower low. It created a new lower. So the market is going to continue like this until, let's say, the market stops going down and it starts going up to break this lower high. Once it breaks this lower high and it starts going up again, then we say the market has broken, the market has changed character and has changed the trend. So, and we also call it trend reversals. So trend reversals also happen. That is what an uptrend, this is what an uptrend is. This is what a downtrend is. So now we say the third market structure is a range. So we say a market is in a range when the market is choppy, when it is not moving in a particular direction. You can see when market moves like this, for example, when the market moves like this, we say it is in a range because it is not obviously going up or obviously coming down. It is stuck within a range. So you can just put a line here and a line here too. So the market is stuck between these two lines. So we call it a ranging market, or we call it a sideways trend or a range. So anything you call it is fine. So I hope you have understood the three types of market structures we have. In an uptrend, we have a series of higher highs and higher lows, and the market is trending up until we start reversing and break this previous higher high to create a trend reversal, or to create what we call a change of character. And the downtrend, market is trending down, creating a series of lower highs and lower lows, until maybe it starts reversing and starts creating a new high. And we say we have a sideways trend or a range. If the market is choppy, it's not moving in a clear direction, it's neither going up nor coming down. So that is what we call a ranging market. Those are the three market structures we have. And don't forget, like I said, in an uptrend, we have we are looking for buying opportunities because you want to be trading, you want to be a friend of the trend. You want to be trading with the trend, in the direction of the trend. In a downtrend, you want to be selling or looking for selling opportunities because you want to be trading with the trend. And in a sideways market, you can trade the bounce of the trend. You can trade buy from this place and trade sell from this place if you are an experienced trader. But if you are not an experienced trader, a beginner, you would want to ignore this kind of market when you start trading. So let's go into the real chart and identify this market. So this is ADA USDT. This ADA USDT. You will see that if you look at this market, this market has been an uptrend from this point going up, but at this point we can say it has started a downtrend movement from this point. Even though this particular place is a range, this particular place is a range. Yes, this particular point is a range. But when the range ended, the market started creating lower highs, lower low, lower highs, lower low. This point, it created something there and started coming down. So you can see, say, it's still in a downtrend because of the structure. This particular point from this movement is an uptrend. This place is a range, then it started falling down. So let's look at Ethereum. Let's look at Ethereum. So Ethereum has been in an uptrend. Yeah, Ethereum has been in an uptrend. You can see the market from this point, it has been in an uptrend. This is a low. Let me just draw what I drew there. This is a low, this is a high. This is a higher low, a higher high. So let me just, so this is a higher low here. This is a higher high, higher low, higher high, higher low, higher high. But at this point it dropped, but it's still an uptrend because it has not broken down from this place. So it created a new high, higher low, higher high. So it is still in an uptrend, even though at this point it is ranging.
at this point it is range, but the market is still generally in an uptrend because it's still giving us highs and lows. So that is what an uptrend simply means. So let's see if we are going to find a market that is in a downtrend. This particular market like this, if you zoom the chart, you can see that there are a lot of things happening in this market. From this point till this point is a downtrend because it's giving us lower highs, lower low, lower highs, lower low, lower highs, lower low. Then it ranged around here. This place is a range. You can see it perfectly. And after the range, the market has started going up little by little, even though the uptrend is not clear and not strong. So that is how you identify a market structure. If you have any question, ensure you put it in the comment section. And if you have any topic you would like me to treat on this channel, put it in the comment section. And don't forget to hit the like button and subscribe to my channel, and I'll see you in the next.
Having understood market structure, you need a technique that is going to tell you when to enter the market and when to exit. When do you look for opportunities to buy and when do you look for opportunities to sell? And that is support and resistance. Support and resistance, and also called supply and demand zones, are areas on your chart that market has reacted to in the past and in which market would likely react to in the future. That is why it is important to understand the concept of support and resistance before you do anything technical analysis. So I'm going to jump right into my screen to show you what support and resistance is, tell you how to draw the support and resistance zone, and tell you how to trade support and resistance as a beginner. So let's jump right into my screen and talk about support and resistance.
Support and resistance is a quite interesting and important topic when it comes to technical analysis, because it's a concept that almost all technical analysts or traders in the world use, even though they may call it different names. Some people call it support and resistance, some people call it demand and supply, some people call it premium and discount. Whatever you call it, it is pretty much the same concept, and it actually means almost the same thing. But then, for the sake of the beginner level, I would like to call it support and resistance for you. And I would like to explain in this video what support and resistance is. Also, this video is part of a crypto course that I've gathered in a playlist on my YouTube channel. So if you are watching this, make sure you check the link for the description to the playlist in the video or in the description below. Check the link for, check the link for the playlist in the description below so that you'll be able to watch other videos in this playlist, and so you'll be able to benefit from other content as well. So in the previous video, I talked about market structure, and I talked about the fact that we have an uptrend where you have the market moving in an uptrend position, something like this. So when you have market going up like this, even though I said the market does not go in a straight line, and I talked about the fact that also have a market structure of a downtrend, and I said that most times in an uptrend you are looking for a buying opportunity, and in downtrend as a trader most of the time you are looking for a selling opportunity or an opportunity to short the market. So that is that for the previous lesson. For this lesson, we'll be talking about what we call the support and the resistance. So what is support, what is resistance, what do they connote whenever you are analyzing the market, and how do you use them to trade profitably in the crypto and the forex market. So specifically, I'll be using the BTC chart for crypto, and I'll be using the gold chart for forex. Even though this is a crypto course, but then I would like forex traders who also watch this video to benefit from it as well. So that's why I'll be using the gold chart to analyze this for the forex market. So what is the support? Yes, I would like to talk briefly about support, the definition of support, even though there is no generally accepted definition, but it's just a concept actually. So support is an area on your chart where buyers come in and push the market higher. So it means that, let me get rid of this line, it means that when you look at this chart, when you look at this Bitcoin market on a 1 hour time frame, you would see that the market, you will see the market coming from this place, come up, come back again, up again. Let me use one of my tools. You see the market came down here, came up again, then down, then up, then down, then up, then down, then it's come up A, then here, right here, here, then here. So I hope you are following. Let me pick this up again. Then the market came down here, came up, down, up, down, and it continued like that. So the bone of contention is that support area is an area on your chart where the buyers would always come in and push the market up. If you look at, if we look at this particular point on your chart, you would see that this is an area of support. Why do you call it an area of support? Because anytime price comes to this area around 35k to 36k, buyers come in and push the market up. It came down again, buyers come in again, push the market up. Price come to that area again and buyers came in again and push the price up. That is what we call a support area. An area where whenever price comes to that area, a lot of buyers come into the market and buy so that the price will go up. And it's a simple psychology. When a lot of people are buying, the market will be going up. And when a lot of people are selling, the market will be declining and the price will be coming down. So that's it. So an area of support is an area. It is not a line. It's not a particular place. It is not just one price. No, it is an area on your chart where a lot of buyers would come in and push the market up and the price will buy. So if you look at this area already also, you will see that anytime price comes to this area, what happens? Price buys. Anytime price comes to that area, the market will go up, and that is why we call this a support level. And support level or a support area is any area on your chart where whenever price comes to that area, a lot of buyers will come and push the market up. Like you see, when the price came to this place, buyers came in and pushed the price up. The price came down again to this area again, buyers came in, pushed it up. Again to this area, buyers came in and pushed it up. So again, price came in here, buyers push it up a little bit again. So that is what we call a support. So now let's talk about a resistance. Resistance is pretty much the opposite of support. Resistance is an area where sellers come in and push the price lower. If you look at this area on this chart, you see that there is a resistance around this place. Something that is resisting the price from going up. Something that is pushing the price back, denying it from going up. That is what the resistance area is. So when the price goes up to this place, there is a resistance here. Sellers. The resistance simply means sellers, and support resistance means buyers. So there is a resistance here where sellers come in and push the price down. You see, it happened here. It happened here again. It happened here again. It happened here again. Until there is a break of the resistance here and the price started going up. So one thing you have to know is that there is always a break of support and resistance. If the support is holding for a long time, there is high probability that at a point it's going to break and it's going to turn into resistance. For example, this place is a support and this place is a resistance. Let me just label it. This is a support. This area is a support. Sorry, I wanted to write support. So, and this area is a resistance. This particular area is an area of resistance. Why do we call this place an area of resistance? Because anytime price comes back to it, it bounces back and comes down. The reason why I call this area of support is because anytime price comes to it, it pushes up and buyers come in and push the price up. So now at this point, the resistance broke and price started going up. So what you expect as a trader is that when price comes to support, you look for buying opportunities. I'm not saying that whenever price comes to support, you must always buy, no, but you look for buying opportunities. How do you get these opportunities is something I'll talk about in a later video when I talk about the candlestick patterns and chart patterns and also entries and exits. But then, you have to understand this principle that supports are areas where buyers come in and buy. Which means when price is approaching a support, you are looking for an opportunity or a trigger that's going to tell you to buy. And when price is coming to a resistance, you are looking at a trigger, an opportunity for you to sell so that the price will come down. But as a trader, you have to be wise, because sometimes the price will come to the support like this. Sometimes the price will come to the support and it will break it. It will break it like this and it continue down, which means that the support has been broken. And sometimes price would go to the resistance, just like it happened here. And instead of it to bounce back, it will not. It will continue going up. It happens. So you as a trader, you have to be able to understand when will support hold and you will buy, and when will support break. When will resistance hold and when is it going to break? So those are the things that you have to understand, and those are the things, some of the things that I'll talk about in this video and in the coming video. So if you are watching this, make sure you watch to the end, and if you're enjoying it, make sure you hit the like and subscribe button. Let me just delete all these things so that we can move forward. So another concept you have to understand is that when a support is broken, it can become a resistance. And when a resistance is broken, it can become a support. So how do we trade support and resistance? There are two things we trade in the support and resistance. We trade the break of support and resistance, and we trade the bounce. I'm trying to change this to a different color. So we change the break of support and resistance, and we change the bounce. So the first thing we trade is the break of the bounce, rather the bounce of support and resistance. That's the first thing we trade. And the second thing we trade in support and resistance is the break of support and resistance. The break. So what does the break and the bounce means? For example, this is an area of support, and we call it an area of support because anytime price comes to this area, it bounces again and start buying. It came again and buyers came in, they push it up again. It came in around here again. It's also an area of support, because when I say support, it's an area, not a particular line. So it came to this area again and it bought, came to the area again, went up, came to the area again and went up. So anytime price comes to that area, it's buy. So the first kind of trading we do with support and resistance is the bounce. It means that we expect that once the price comes to the area of support, it is going to bounce. And when it bounces, price starts going up. That is what we call the bounce of support and resistance. How do you know when it's going to bounce? It's part of the things I will talk about in the coming video. So stick around. So the second thing we trade is the break. Sometimes the price will come to the support, break it, and start going down. So when do you know, how do you know if it's going to break? It's also something I'll talk about in the coming video. So it's when you are trading support and resistance, it is either you trade the break of support and resistance or you trade the bounce of support and resistance. Most of the times, what we trade is the bounce, because support and resistance bounces a lot of times. It bounces much more than it breaks. You can see that from this diagram, you can see that support and resistance has bounced several times. Let's look at it. Let's draw it as an area. You can see it has bounced several times, like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, like almost 10 or more times it has bounced. But it's going to break later on. So that is what happens. And if you look at this area, you will see that there seems to be an area of resistance. I said the resistance is where sellers are shorting. You can see sellers shorted at this place. They shorted again here, again here. They took a sell again here again, and price came down. They put the price down again. But at this point, they could not push it down again, and it broke. So you have to be able to identify when it's going to break and when it's going to bounce. So, and like I said, I'll talk about that in later videos. So now let's go to one important thing. How do you draw support and resistance? How do you identify support and resistance? Then how do you draw them? Let me get rid of the drawings on my chart first, so that I'll be able to show you properly how to draw them or how to identify them. The first thing you have to look at is that you have to zoom in your charts. You have to zoom in your chart. Maybe I should just do this on the 4-hour time frame. Cool. So that I'll be able to see a lot more things. Perfect. So the first thing you do is that you zoom in your chart. You zoom in your chart. Then you draw the swing high and the swing low. The swing low means the most obvious level you are seeing. That is the lowest obvious level. This is the lowest obvious level. And the swing high is like the highest obvious level. Somewhere around here. Somewhere around here is the swing high. Even though this is the highest point, but then we can just put it somewhere around here. That's an area of resistance. This is an area of support. Then you look at the chart. Where are other places where you can find areas of support and resistance? You can see this is an area. Then you can also identify this particular point as an area. This area also seems to be an area of support and resistance. This is somewhere around here. But then another thing you have to know is that we have global support and you have local support. Global support are support and resistance that you draw on the higher time frame, and local support are support and resistance that you can draw or that you draw on the lower time frame. This will be discussed later also, but then for the sake of this video, you have to understand that when you are drawing support and resistance, it's good to draw them on the higher time frame, like maybe the weekly, the daily, and the 4-hour, especially if you are a swing trader. And if you're a day trader, you can draw them on the 4-hour or the 1-hour and look down on the other time frame. So those are areas of support and resistance. Then the next thing you do is that you adjust it to get the most number of touches. You can see you can just adjust this a little bit up so that the line can touch a lot of places, or you can use this one so that it's going to cover a lot of areas. Some traders use line, some traders use this particular tool. Though I prefer to use this particular tool so that because it's going to cover a lot of places, because support and resistance is not just a line, it is an area, and that area is always an area on your chart where anything that has happened there in the past is likely going to happen again in the future. Look at this area, for example. This was March 2023. Market came to this place, March 2023. Then it came to this area again, June 2023. It came to it again, 17th of June 2023. It came to it again, 12th September 2023. And also around 27th September and also around 16th October 2023. That means any area of support is an area that has already been marked on the chart that buyers would expect the market to come to that area so that they can buy again. So, but when you are trading, what matters to you when you are trading is that the current area, the area of support that is currently close to the current price. So if you are trading now and you want to analyze the market, this is the major area of support and resistance you would be looking into. These major areas are where you'll be looking into. This place as a support and this place as a resistance, because this is where the market is currently trading. So that is what I'll be teaching you in this video about support and resistance. I also have another additional video about support and resistance on my YouTube channel. I'll link that in the description below or somewhere around this video, so you can watch that also for additional information. If you got value from this video, ensure you hit the subscribe button and also like the video. Also, I would like you to do something, which is put a comment in the comment section and tell me which topic about crypto or forex topic you would like me to talk about, and I would surely talk about that. Also, for the sake of forex traders, if you like to draw support and resistance for something like this is the daily time frame. You can just look at the lowest area, which is somewhere around this place. Somewhere around this place is an area. This is on a higher time frame, please note. Then you draw somewhere around here. This is on a higher time frame. But when you switch to the lower time frame, you will see the immediate levels. Yes, you will be able to draw some other minor support and resistance level you would be trading from. You can see this is a minor area. You can just put it this way. This is also a minor area that you can trade from. So support and resistance is actually drawn this way, and it depends on the time frame you are using, and it depends on whether you are a swing trader, a scalp trader, or a day trader. So make sure you watch the other video on support and resistance too. It has some other explanation.
Support and resistance, as I just explained, has explained to you where you enter the market and where you look for buying opportunities and where you look for selling opportunities. But just as I said, just because the market is at support doesn't mean you must buy. And just because the market is at resistance does not mean that you have to sell. There is actually a particular thing that you have to look into before you take that buy trade and sell trade, and that is what we call candlestick patterns. Candlestick patterns are candlestick formations or candlestick pattern formations that form at particular points in the market that tells you this market is about to move. For example, the bullish engulfing candlestick pattern is a candlestick pattern that tells you that the market at this point is bullish and there are a lot of bulls in the market compared to bears. It tells you that the market is about to move. So when the market is at a support or as resistance, you still have to look for candlestick pattern formations to tell you that this market is about to kick off, and this is when you enter the market. Even though you don't just enter when you see these candlestick patterns, because I'm going to tell you later in this video, I'm going to talk about entries and exits, but candlestick pattern serves as like 50% or more confirmation about the movement the market is about to move at areas of values, support and resistance, or supply or demand. So let's jump right to my screen and let's talk about candlestick patterns.
But in this video, I'll be talking about candlestick patterns. Remember, as in the last 3 or 4 videos, I talk about candlestick charts, how these candlesticks form and how to read them. But then there's another topic which I'll be talking about in this video called candlestick patterns. It is a brand new topic that explains more about candlestick. You can see this is it. It is a brand new topic that talks more about candlestick and the patterns this candlestick form on the chart. And when talking about candlestick patterns, we have a lot of candlestick patterns. If you look at trading books and trading journals, you see you can see more than 50, 100 candlestick patterns with different names. You see them here. We have a whole lot of candlestick patterns. But what really matters for you as a trader is understanding the interpretation of these patterns and how you can use them in your day-to-day trading activity. So candlestick patterns basically are a kind of formation or configuration or patterns in which candlesticks form on the chart. And these patterns give you a kind of meaning. And with some of these patterns that are formed, you'll be able to identify or figure out what is likely going to happen next in the market. That is what candlestick pattern is all about. So guys, I am Arab the Plug, and if I just joined my channel for the first time, ensure you subscribe to the channel and hit the like button, because on this channel I teach how to trade cryptocurrency and the forex market, and I talk a lot about technical analysis and also personal finance. So if you are interested in any of this, make sure you subscribe to the channel and you hit the like button. And if you have any question regarding crypto and forex, make sure you put it in the comment section so that I can look into it and talk about it in one of my next videos. So if you want to learn candlestick patterns, make sure you stick to the end of this video as well, because this video is going to be value packed and I'll talk about some of the most important candlestick patterns you can see in the crypto and the forex market. So let's go. So for the sake of this video, because I don't want this video to be too long, I will not be talking about all the candlestick patterns we have in the market, but I will pick some of the 3 candlestick patterns that I have mastered and I have been using over the years, and I have improved my trading over the years. So I'll be talking about just 3 candlestick patterns. So if you master these 3, you'll be able to trade profitably in the crypto and even in the forex market. So the first candlestick pattern I'll be talking about is what we call the engulfing pattern. You can say it again, the engulfing pattern. So the engulfing pattern is of 2 types, the bullish engulfing and the bearish engulfing. So what is the engulfing pattern? What does it mean? The engulfing pattern, as the name suggests, means that you have two candlesticks formed together, in which one of the candlestick engulfs the other. It is as it is named. There are two candlesticks in an engulfing pattern. One candlestick engulfs the other, which means one candlestick is bigger, is much more bigger than the other. So in the case of bullish engulfing, it means that the first candle, the previous candle is red, which is bearish candle. Then, in a bearish candle, what it signifies is that the sellers are in control of the market in a bearish candle. Then after the bearish candle, a bullish candle now comes after it, engulfing the whole of the bearish candle, showing the strength of the buyer, telling you that even though the market has been going in a bearish direction, but now that we have this big green candle following the previous small red candle, the buyers are now strong and they are now ready to push the market up. That is why we call this one a bullish engulfing candle. And the second kind of engulfing candle we have is the bearish engulfing candle, just the opposite of the bullish engulfing, which is pretty much telling us that the market has been bullish, then this previous candle is bullish as well, but then after it, a strong bearish candle is formed, engulfing the previous bullish candle, telling us that the market is likely going to start going bearish. So bullish engulfing candle is a candle that you as a trader look for at the support level, because at the support level you want to be buying. So that is why in technical analysis you have to combine all the things you learn together. You can't trade support and resistance in isolation, like I said in the previous video. And also, you can't trade candlesticks in isolation. So when you are trading support and resistance, for example, you look for candlesticks that are telling you that the market is going to go bullish. One of them is the bullish engulfing candle. So let's say, for example, you are at the support level, at the support level, and this is an example of a trade I took, I think 4 days ago. Let me just show you so that you know this is a trade I actually took. This is a trade I actually took. So you can see I saved this trade exactly when I was about to take the trade. You can see this was 25th of January, and today, as the time of recording this video, today is 30th of January. That was just like 5 days ago. I took this trade. Why did I take the trade? I'm going to explain using one of the concepts of the. You see that this is an area of support. I took the trade on Solana. This is an area of support. And like I said in the previous support and resistance video, as support, you are looking for opportunities to buy. So now, in this place, the opportunity presented itself because I found some candles telling me that the buyers are now in control. Which candle did I find? Let me just highlight the candle for you. This candle called the bullish engulfing candle. You can see this bullish engulfing candle. This is a previous bearish candle followed by, so let me use this this is a previous bearish candle. You can see the candle is a bearish candle at the support level, followed by a bullish candle. This is the bullish candle that followed it, indicating the strength of the buyers. And what happened afterwards? The market rallied a little bit and then it started moving towards my area of projection. The trade has not hit my take profit, but you can see I am in a massive profit. So it's actually a live trade, not a kind of something that happened in the past. It is a trade I personally took just 5 days ago. That is what the bullish engulfing candle does. When you say bullish engulfing candle, especially at an area of support, it's telling you that the market has been bearish for a while, just like you have it here. The market has been coming down from this point. The market has been coming down from this point, rallying down, came up, down, then it tested this area, cleared liquidity, then came back to this support. So when it came back to this area of support, I was looking at an opportunity for me to buy, and I found that bullish engulfing candle, and I took the long trade. And when I took the long trade after the bullish engulfing candle, what happened? the market started moving. So the same is the case for a bearish engulfing candle. If you want to trade a bearish engulfing candle, you look at areas of resistance, areas where the market is likely going to bounce and start shorting. This is one of the areas. This is an area of resistance on this chart. And if you look at this chart, you will see this is pretty much a bearish engulfing candle. Let's look at you see this is a bearish engulfing candle. A bullish candle followed by a very strong bearish candle that engulfs it. And let's see, this is a bullish candle followed by this bearish candle that totally engulfs it. And one of the things I used to tell people about bullish and bearish engulfing candles is that you must make sure that the second candle totally engulfs the first or the previous candle to be able to call something bullish or bearish engulfing candle. So at this point, when the bearish engulfing candle came, what happened after it? The market shorted. So let's say you are trading this area, just as an example, and you spot this bearish engulfing. You are just going to enter the trade after the bearish engulfing candle. Just after the bearish engulfing, even though I'm still going to make a video about entries and exit, and your target is going to be the next area of support. And what happened in this trade is a trade of at least 1:2 risk to reward that came true. So that is what a bearish engulfing candle and bullish engulfing candle simply. So let's get to the second kind of candle we're talking about is the morning and evening star candle. The morning and evening star candle resembles bullish and bearish engulfing candle. The only difference is that morning and evening star candles are three candle formation. Bullish and bearish engulfing are just two candle formation. This is a bearish candle followed by an indecision candle. This candle, we call it indecision because after the bearish candle, we are supposed to see a strong bullish candle that is going to tell us it's about to reverse. The market is about to reverse, just like we had in the case of bullish and bearish engulfing. But we did not see that candle. We first saw an indecision candle telling us that the market has not decided. The market participant has not decided whether they are going to continue being bearish or bullish. Then after the indecision candle, we now saw a bullish candle. That is what a morning star is. The opposite for evening star, we have a bullish candle going to an area of resistance. Then we have an indecision candle telling us the market is not trying to continue bullish. The indecision candle is red actually, but it is not a strong candle. It does not have momentum in it. It is very small. Then followed by a candle that confirms that now this movement is about to turn and reverse to the opposite direction. So it is pretty much like the bullish and bearish engulfing, but the difference is that before we have the next candle that confirms the reversal, there is always an indecision candle. And this candle is very strong, especially when you see it on a higher time frame. Last year, 2023, I called on my channel. If you watch some of the videos I talked about on my channel, my analysis video, you see that I talked about Bitcoin in January 2023. I talked about Bitcoin and I said Bitcoin is going to pump. I said last year was going to be bullish. And what I saw was that I saw a morning star on Bitcoin. You can see this is the morning star, bearish candle, followed by a series of indecision candle, then a strong bullish candle. So this is exactly what I saw on the weekly time frame. This is a bearish candle. This is an area of support, like an area of support. This is a bearish candle. And after the bearish candle, we have a lot of indecision candle, which means that the market has been going down. But when it got to this stage, they were trying to push it down again and again and again, but they could not succeed. They could not succeed at pushing it down. And then we saw this strong bullish candle. And what happened? The market pumped from around 20k last year to around 45k in December last year, 2023. So this is one of the candles that a lot of traders use. You can see it is much more clearer here on the monthly time frame. If you look at it on the monthly time frame, you will see it clearly. This is exactly the same thing you have here. A bearish candle followed by an indecision candle, then followed by a strong bullish candle. Just as it is here, a bearish candle in November 2022, followed by an indecision candle, telling us the market is not going to continue going down in December, and a strong bullish candle in January. That is what morning and evening star candle is all about. If you look at the Bitcoin chart, you're going to see a lot of this kind of candle. So this is something that resembles morning and evening star, but unfortunately, this is not a strong area of resistance. So another thing is that all these candles, like I said earlier, you are going to be trading them at areas of value, areas of support, areas of resistance is where you'll be looking. You don't just trade this candle just anywhere you see them on the chart. You trade them at areas of support, areas where you see this area is a strong area of support where the market has respected several times. This is an area of support too. This is also a likely area of value. Yes, the market has. So trade this candle at these areas on your chart. And also, the third candle I'm talking about is the hammer and inverted hammer. You can see this candle looks like a hammer. A hammer candle is a candle that has a small body and a very long tail or wick. We call this thing tail, we call it wick, and we can also call it a shadow. You can call it a tail, you can call it a wick, W-I-C-K, and you can call it a shadow. So a hammer candlestick is a candle that has a small body and a very long shadow, a very long wick or tail. So what's the essence of this candle? This candle is telling you that this market opened here. This is the open of the market. The market opened here. Sellers tried to push the market down, but the buyers recovered and pushed it to close up here. So it's a very strong bullish candle. And what's this candle trying to tell us? You can see this candle. One thing about Bitcoin market is that this candle is, you can see them a lot on the Bitcoin market. This is something like it. Look at this. The market has been moving up from this place, went up and came to this place. When the market came to that place, it hit a resistance, right? It hit a resistance. That's an area of resistance. Let me just put a line here. That's an area of resistance. Right? So when it hit that, you now saw that the market went up and got rejected. Like this candle is a 4-hour candle. So within 4 hours, within this movement of 4 hours, the market opened here, came down, the market opened here, rather, went up from $47,000 to $49,000 within 4 hours, and it dropped back to $46,000, telling you that buyers try to push the market up, but it seems they are exhausted. It seems they are exhausted and did not have enough prayer to push the market up. And what happened after it? The market collapsed. You can see the market collapsed from this point where it closed, 46.8 or so, collapsed to 41K, then also to 40K, then also to 38K. That is a strong candlestick. That is a strong indication that the market is going to collapse. If you see it at a support area too, if you see that kind of candle at the support area too, if you look at areas of support, you see that candle a lot. Looking at, okay, this is something like that, but even though this one we call it a dodgy candle, this is not clearly a hammer or shooting star. That is clearly a dodgy candle. I'll talk about dodgy candle in some other videos. But then the point of contention is that when you see a candle like that, it signifies that when the market participant tried to push the market up at some point and it got rejected. Imagine a candle, just one candle, 4-hour candle, and you have a big movement going up and coming down again. It's telling you that those buyers in that market are exhausted and the market is about to reject and reverse. So that is that about candlestick. So if you see this kind of candle at the area of support and this one at the area of resistance, is pretty much telling you that the market is about to reverse, and anytime from then there could be a collapse in price. So
chart patterns are actually a very important concept in technical analysis, and I know some traders that only trade chart patterns, from the head and shoulders, inverse head and shoulders, double top and double bottom. All these chart patterns are patterns formed by the chart. Even in technical analysis, we have the triangle pattern, we have the wedge, and we have all these patterns. Patterns are formed on the chart, and when they are formed on the chart, they have a meaning and they have a message they are trying to convey to the trader or the analyst. So when you see these patterns on the chart, you must be able to identify them. And that is why it is important that I teach you some of the chart patterns, because we actually have a whole lot of chart patterns that if we get into a chart pattern video, we might spend more than 2 hours explaining all these chart patterns. So in this video, I'll be talking about a few chart patterns that are absolutely important and that are going to improve your trading game. So let's get right into my screen once again and talk about chart patterns.
In this video, I'll be talking about chart patterns, which is a very important topic when it's come to analyzing the cryptocurrency market. Chart patterns simply is about some patterns that are formed on the chart, and there are some kind of price action strategies that traders use to analyze the cryptocurrency or the forex market, and that we use to place our trades to be able to get reasonable decisions to make money from the internet. So if you are just getting to see my channel for the first time, this is Arab the Plug, and on my channel I talk about how to trade the cryptocurrency market and the forex market, and I also talk about personal finance. So if you're interested in any of these things I've mentioned, ensure you subscribe to my YouTube channel and make sure you hit the like button on this video, and let's get right into it. So in the previous videos, I talked about support and resistance, candlestick patterns, candlestick chart, and everything. And this video, I'll be talking about chart patterns, because these are some of the things that are formed on the chart that traders use to make accurate trading decisions whenever they are about to place a trade. So chart patterns is a very important concept that a whole lot of traders use, and in the crypto market, we have a whole lot of chart patterns. So chart patterns are a lot, and you cannot actually master all of them. That is why it is important that you look for some of them that have stood the test of time over time, that people have used and that have made people a lot of money in the market. So as far as I'm concerned, I usually trade 2 or 3 patterns, 3 to 4 patterns, and these are the patterns I'll be covering in this video. I will not be covering all the patterns, even though I'm still going to make another video where I'll talk about like 10 of the chart patterns that we have in the market. But for the sake of this video, I'll be sticking to 2 to 4 of these patterns. The first one I'll be talking about is what we call the double top pattern. Double top pattern is simply about a pattern that we usually see in an uptrend, which is a reversal pattern. So this is a clear uptrend, as you see. Then in an uptrend, when we see a double top pattern like this, it is signifying that the market is about to reverse and the trend is about to change. So double top patterns simply insinuate that in an uptrend we have a double top, and this is what a double top looks like. The market is going in an uptrend and a high is formed, then the market reverses. And you know, in market structure, when the market reverses like this, you expect a new high to be formed. Then the market goes up and the market fails to make a new high. So the market goes up and make a stop around here, or it even comes up here and stops and starts reversing. So that is what we call a double top pattern. So it simply signifies that market has been going up in an uptrend, reverses a little bit, and when the market reverses, you expect the market to form a higher high, but instead of forming a higher high, it created a lower high, or a low, anyhow we call it. So that is what they call a double top formation. So if you look at it critically, you will see that this is the first top and this is the second top. That's why we call it a double top. Then we also call it a M pattern. because it looks like the letter M. So we call it double bottom pattern, and we call it a M pattern. Then we have something we call the neckline. So whenever double top pattern is formed, this place where the market reverses to is what we call the neckline. We call it the neckline, and it also serves as a support pattern. So how do you trade in double top pattern? It is simple. You wait for the break of this neckline. You wait for a situation where this neckline will break. Then most times you wait for a pullback and enter a short. Even though most of the time the pullback does not happen, and the way I trade this pattern is that I look for the candle that breaks. I look at the candle that breaks the neckline. If it's a momentum candle, a candle that has a lot of momentum in it and is very strong, I enter at the break and put my stop loss somewhere around here. My stop loss is somewhere around here, and my target would be the next level area on the chart. So that is how I trade the double top pattern. And most of the times, if the candle that breaks the pattern is not a momentum candle, let's say the candle does not have a lot of momentum in it, I wait for a pullback to this area before I enter here. So that is how I trade the double top pattern. And if you look at this double top pattern, if you look at the double top pattern, you would see that we have a lot of examples of it in the chart. So if you look at this chart, the market has been in an uptrend, going up and down. Then it reached a top here. When it reached the top, the market reversed from this top to create the neckline here. It went up again, but it could not continue pushing up, so the market started dropping. So this is, looking at this particular example, this is the neckline. This is the neckline right here. This is the neckline, which also serves as a support. And when the neckline broke, what happened? The market started going down. And you as a trader, you enter at the break of the neckline, especially when the candle that broke the neckline is a momentum candle. Put your stop loss around here and put your target around here, because this particular area is the next level target. If you look at the chart using the support and resistance strategy that I have talked about later, so this is going to be your target for this kind of trade. That is basically how to trade the double top pattern. So after the double top pattern, we have what we call the double bottom pattern. Double bottom is more like a double top that is flipped around. So if you flip the double top, it's going to give you double bottom. And this is how the double bottom simply works. It's more like the market is in double bottom. It also is a reversal pattern, more like the market is in a downtrend, more like having a market in a downtrend. Right, so for the double bottom formation, it's more of like the flip side of the double top. It means that the market is in a downtrend. Double bottom is also a reversal pattern. The market is in a downtrend, and the market creates a new low, then a reversal happens, then the market tried to go lower, but it could not go lower, and it got stuck maybe around here, or even here, or even sometimes it goes a little bit lower and it refuses to go down. So then we have something like this. So once this happens, we would have this place called the neckline, which is also the form of a resistance. You know, in the double top it was a support, but here it will be a resistance. And I'll trade it just like when the market breaks this resistance or the neckline with a momentum, I'm going to be entering immediately. I'll put my stop loss somewhere around here. Somewhere around here. My stop loss will be somewhere around here, and my target will be the next level target. So this is exactly what we have in this chart. If you look at this Solana chart, you will see that this is a clear double bottom formation. The market was in a downtrend. Market came down to this place, reversed to this neckline, came down again, but it could not threaten the previous low. Then the market started moving up from this neckline. So like I said, when it comes to double top, if the market broke the neckline with a momentum, I'm going to enter immediately. But you can see here, the candle does not have a lot of momentum in it. So in this case scenario, I'll be waiting for a pullback, just like I said. with the double bottom, with the double top rather, I'm looking for a pullback when the market breaks, then a pullback to this level again before I shoot up. So my target would be the next area of support. My target would be the next area of support on the chart, which would be somewhere around here. This would be my target. Even though I took this trade, but I didn't trade the double bottom. Actually, I took this trade just like on the 25th of January 2024. I took this particular trade, but I missed out on this entry on the double bottom. Then I caught another entry around this area of value, area of support, which could have been my initial target if I had traded this double bottom. So this is how to trade double top and double bottom. The next one is head and shoulders and inverse head and shoulders. Head and shoulders simply pretty much looks like double top and double bottom, but I think we can find that in BTC chart. BTC formed a head and shoulder in 2021 when we had, let's look at the daily time frame, when we had Bitcoin reaching an all-time high. So head and shoulders simply is something like this. It's like when you have a situation where the market when you have a situation where the market is an uptrend. Head and shoulder is also a reversal pattern. It's like this when you have a situation where the market is in an uptrend, then you have a situation where the market is in an uptrend, the market moves up, then comes down, you have a situation where the market is an uptrend, reverses a little bit, then make a new higher high, reverses, then at this point you expect the market to make a much higher high, then comes to this place and start dropping. That is what we call a head and shoulder. If you look at it, you will label it, this is the right shoulder, this is the left shoulder, this place is the left shoulder, this is the right shoulder, and this is the head. That's why we call it a head and shoulder. And also this one also has a neckline. So the logic behind this kind of pattern is that the market was pushing up, pulled back here, made a higher high, and when the market makes a higher high, what you expect is that you don't expect a pullback to this place again, even though it happens once in a while, but you don't expect a pullback to this place again. But when you have a pullback to this place, you expect a much strong movement, and you expect the market to make something very much higher. But then the market could not threaten this previous high, and then it stops around this place, and you say it has made a double top. This is what a double bottom also looks like. In a double bottom, the market is in a downtrend, made a low, pulled back, made a lower low, then pulled back to this place or around this place. Then you expect it to make a low that is going to be lower, but it could not. Then it stopped around there and started reversing. So you see this one is a double bottom, and this is the neckline. So I trade the double top and the bottom just like I trade the head and the shoulder. If the break of the neckline came with a very strong candle, a momentum candle, breaks with momentum, I'm going to enter immediately, put my stop loss somewhere around here, because I don't want to be risking too much, somewhere around here, and the next target will be the next area of value. Same thing, but if it does not break with momentum, then I would be expecting a pullback. If it breaks like this, I'll be expecting a pullback. I'll be expecting a pullback to this area of neckline before I start shorting. So that is how I trade both the double top and the double bottom. So let's look at this BTC chart and look for where we could get a double, not double top, not double bottom. I mean head and shoulders and inverse head and shoulders. On BTC in 2021, we had something like a head and shoulders. We had a situation whereby the market was in an uptrend, pushed up, came back, market pushed up, came back here, pushed up again, came back. then tried to push up, but it could not threaten the previous high and started dropping. So when it started dropping, the market formed a neckline around here. Market formed a neckline around there, and you are going to enter at the break of the neckline if the break was with a momentum candle. And where would your target be? The target would be the next area of value. And what happened? The market broke the neckline and smashed this area. That is pretty much how to trade the head and shoulders and also the inverse head and shoulders. So it's pretty much the same thing. Head and shoulders and inverse head and shoulders is just the same pattern, just that head and shoulders form when the market is an uptrend, and inverse head and shoulder form when the market is in downtrend. And also for the double top and double top is a reversal pattern that forms when the market is an uptrend, and double bottom is a reversal pattern that forms when the market is in a downtrend. So that is pretty much how to trade these two, or just 4 particular patterns. I hope you got value from this video. Ensure you.
The 6th concept we are going to look at in this exclusive technical analysis course is trendline strategy or trendline trading. Trendline is a form of support and resistance that we call the diagonal support and resistance. We call it diagonal support and resistance because trendline is a line that connects 2 or more swing points in the moving market or in the trading market. Let's say, for example, the market is in an uptrend and you want to connect some parts of the movement of this uptrend. So trendline is a tool that's used to connect movement of the market when it's an uptrend or a downtrend. So when the market is an uptrend, you can draw a trend line to connect the swing point or the support, the trend line support of the market. And when you are in a downtrend, you can also do this. I'll explain this more when I jump into my screen. So let's get into my screen and explain how you can use trend line as a support and resistance, and how you can actually trade trend line and become a profitable trader doing that.
Welcome back inside my screen, and in this part of the video we'll be talking about trend lines. What are trend lines? Trend lines are a form of diagonal support and resistance that you can use to identify areas of value on your chart. So when you see trend line is always found in a trending market, and that is why we call it trend line. It's a line trying to tell you what the trend is moving, how it is moving, and where during the trend can you find opportunities to trade. So trend line is more of a support and resistance level or line or area that you can use to trade the market in a trending market. So if the market is trending upward, we call it an ascending trend line. Something like this is a trend line, right? So we call it an ascending trend line because the market is in a clear uptrend. And at this point of the market, when the market was in a downtrend, we can actually connect something like this and call it a descending trend line. But because the market has moved past that area, we would not be drawing that. So trend line is more of a line that helps you connect swing points, common swing points where you can trade from in a trending market. And also trend line is a form of support level, is a form of an area of value, is support in an uptrend and a resistance in a downtrend. So what you do is that when you have a trend line like this, whenever the market comes to the area of trend line, whenever the market reverses to the area of trend line, you look for opportunities to continue buying because the market is in an uptrend. And when you see something like, you see that in this market, in the case of this particular market, NZD CHF Forex pair, you see that the market came back with trend line, respected it, pushed up, came back to it, pushed up again, came back to it, pushed up a little bit, came back, broke it, but it was a fake out, and then continue uptrend. So anytime the market comes to this area of trend line, we expect that the market respect the trend line and continue uptrend. Also, it happens that sometimes the market comes to trend line, break it, and whenever the market breaks the trend line and closed below it, if you look at this scenario here, you see that the market broke the trend line just to clear some liquidity, and because there is also an area of support here, right? There's also an area of support there, there's a horizontal support there. So the market sometimes might break the trend line, but it would not hold. Once it breaks, you will see that the market will quickly reverse. And that is what happened. What happened is that a lot of traders are longing the market from this trend line. They are continuously longing the market, and there's a lot of stop loss below the trend line, which is like liquidity concepts, an advanced concept in trading. So the market is trying to clear some of the stop losses that are available below the trend line before the market continues reverse. That is why you as a trader, you have to be very clever, and you have to have a deep understanding of stuff like this, so that you don't get caught up in situations like this. And it is very important. So whenever the market comes to the trend line, you expect that the market will respect the trend line. And sometimes the market comes to the trend line and it breaks it. And whenever the market breaks below the trend line and stays below it, after you have looked at some valid confirmation, maybe the 4-hour candle or anything you used to confirm, and it stays below it, you'll be rest assured that the market is likely going to reverse, and maybe the trend is going to change to a downtrend from an uptrend. So for example, if you look at this particular market, there was a scenario where the market was trending down here, somewhere around here. Market was trending down around this place, and anytime the market comes to the trend line, you see right from here, came to the trend line, bounced down, came to the trend line, bounced again, came to it again, bounced, and here the market came to the trend line and broke it, and a new trend started. So that is pretty much what a trend line means. Trend line is more of a diagonal support and resistance levels that you use to identify the trend of the market, and also it gives you opportunities on where you trade from. So just like you trade from horizontal support and resistance levels, you can also trade from support and resistance level. And also there are some traders that the only thing they trade is breakout of the trend line. They trade the trend line break. So there are two things you can do when you have trend lines drawn on your chart. You can trade the bounce of the trend line, and you can trade the break of trend line. The bounce means that whenever the market comes to the trend line, just like this, you'll be waiting for the market to come back to this area. You'll be looking for opportunities to continue the long trend. So when the market comes to this and gives you maybe a bullish engulfing or a hammer or something like that, you look for entries to continue longing the market. And then if that does not happen, the market works in probabilities. If that does not happen and the market breaks trend line, then you look for break confirmation to short the market. So maybe a bearish engulfing candle or any bearish candle that you can find around the market. So that is pretty much what trend line means. So let's look for trend line in some other assets. You can see this is gold. This is the gold chart, 15-minute time frame, and you will see that the market is in a clear uptrend, but there isn't any opportunity to draw a trend line here unless you're going to pick something like. One other thing about trend line is that you don't force it. You don't force it at all. Once you don't have an opportunity to draw a trend line in a chart, you don't force the trend line. So the rule is that before you can call a trend line, there must be at least two major swing points. At least two major swing points. You can see that here you have a swing point around here this week, and also a swing point here. So anytime the market comes back to this trend line, you see that you look for opportunities to buy, unless there is a break and retest below the trend line, then you look for shorts. So that is what trend line is. So to draw a trend line, you know that there must be at least two major swing points that are connected. It can be more than two, it can be 4, it can be 5, it can be 6. There are some trend lines that, if you look at higher time frame of something like GBP USD or Euro USD, you would see that. Let's look at higher time frame of GBP USD and Euro USD. So this is Euro USD. You would see that on Euro USD, you actually can draw a trend line right here, right, you see this is a perfect trend line connecting three major swing points on the chart. The first one was this point where it started from, which was July 2023. Then the market came back and respected that trend line again in September 2023. And also the market came back and respected the trend line again in October 2023 before it broke out of the trend line right here in October 2023. So you will see, as a trader, all you have to do whenever the market comes to this trend line is confirm whether it's going to respect trend line or break trend line. And in the case here, you see that when the market came to the trend line, a bearish engulfing candle was formed. And what happened? You can call this a bearish engulfing, or it looks like something like a tweezer top, which is like a candle that tells you that the market is going to continue bearish. And what happened afterwards? The market dropped. So that is what a trend line means. So if you look at higher time frame of some of the coins like Euro USD, let's look at GBP USD as well. You will see that there are a lot of trend line opportunities to trade on a coin like GBP. Right, if you look at GBP at some point, you would see this is a trend line, even though I may not be drawing something like it, but it's pretty much a trend line dating back to this point, which was 2022 October. Then the market came to the area, respected it again in 2023, and again like that. So trend line gives you an opportunity to look at the market in a broader sense and give you an opportunity to get a way to trade the market in a more dynamic way. So this is pretty much about trend line, and the next section we'll be talking about something else, probably entries and exits, so that we can look at all these concepts that we have talked about in this tutorial and find a way to join all of them to make accurate trade decisions.
Now that you have learned all these concepts, you need to understand that these concepts, even though they are enough for you to trade, you still have to be at the top of your game. And that is why you have to understand the concept of entries and exit. There are actually strategies by which you can enter the market and exit the market, because as a trader, when you are getting to trade, you must be sure of where you would get out if you are right, and also where you would get out if you are wrong. So your entries is where you get into the market, and your exit is where you get out if you are right. That will be take profit, and where you get out if you are wrong, that will be stop loss. So you have to understand that you could be wrong sometimes. It doesn't mean that the market is wrong or the market is faulty. Your technical analysis or your strategy or your bias might be wrong at some point. So you have to understand that you need some strategies or techniques to use to enter the market, and you need some to use to exit the market. So I'll jump right to my screen right now and teach you how you can get the best entry for your trade and how you can get a very cool exit for your trade.
Hey guys, in this part of the video, we'll be talking about entry and exit strategy, which means how do you enter the market and how do you exit the market. And that is why, because if you are a trader, it is very important that apart from understanding the candlestick pattern and all those concepts that you learn in technical analysis, you should be able to form a hypothesis for yourself, and you should be able to form some rules by which you enter the market, because you don't want to enter the market, get stopped out of the market before market start going to your direction. You see that as a trader, it happens that sometimes you enter a trade, you have a bias that the trade is going to go long, and it's eventually going to go long, but before it goes long, the market clears your stop loss and starts going in your assumed direction. So that is why it is important that you form some kind of strategy or some entry and exit strategy that you set as criteria before you enter the market. So every trader should have a strategy, and in this video I'll be showing you some of the strategies that I use before entering a trade, some of the conferences that I look into before entering a trade, and I'll be using some forex and crypto pair to explain this particular concept. So looking at EuroCAD, This chart is on a 15-minute time frame and the market is pretty much in an uptrend, and that is why I have a trend line I could extend to this area. Okay, I could extend to this area, or probably pick it from this area. So this is kind of dicey. Okay. This is a little bit perfect because it is touching much more areas. So I have a trend line on this chart and I have an area of interest around this zone. This is an area of demand, and we call it an area of demand or area of interest because the market has pretty much respected this area. So the first thing I do is that once I identify the trends and I pick a bias, actually the market is an uptrend, and right now the market has come to an area that the market has always respected. So which means that anytime the market comes to this area, the market has always bounced up. But then another thing you have to look into is the fact that sometimes when the market comes to areas of value, like when the market comes to this area, so let's look at what has happened. The market has been an uptrend and it came to this area, bounced back, give us a higher high, bounced back to this zone, came up, but it could not beat the previous high, came back, came up, and came down all the way. So what this is telling us that the market is still in an uptrend, but the trend seems not to be very strong because the market has not been able to give us a much higher high with a strong momentum. So it means that we should be looking at this area of confluence. This area is very dicey, and we should, even though we are still long, we should be looking for a situation whereby if the market breaks below this zone, we might be shorting for a while because of this trend line that is around here. So if the market does not give us a bullish confirmation, a bullish movement back to these highs, we might be looking for a way to short the market to this area, or maybe this candlestick is going to serve as a confluence for the markets to continue going higher. So the bias is high, but you have to look at the different situations available in the market. That's the first thing. I look at the bias of the market, the structure, which is the uptrend, and I look for areas of interest on the chart, which is this particular area. Then one of the things I look at is I look for the higher time frame and see what candlesticks are forming on the higher time frame, especially the 4-hour and also the daily. So you will see that the daily candle for the past few days has been bullish, though you had a bearish candle for the previous day, and today it has been a little bit bullish. So this bearish candle formation is telling us that the market might reject from that area of value. Then we switch to the 4-hour. We see that the market is still a little bit bearish on the 4-hour, but we have hit this major support on the 4-hour, and we seem to be having some form of candles that are not really giving us momentum. So in this kind of trade, I would be looking for a situation whereby I will get a 4-hour candle that's going to be bullish, maybe a bullish engulfing candle on a 4-hour before I jump into any buy trade, or maybe a clear breakout of this area. So this is it. A clear breakout of this zone, which is going to be a 2-time breakout. Why is it going to be a 2-time breakout? It's because if it breaks out of this area of value, it's going to be a breakout of the trend line that has been respecting for a very long time, and a retracement back into this area. So once I get a bearish breakout and a retracement back into this area, then I'll be looking for a bearish engulfing candle, like a bearish engulfing candle, or maybe any form of reversal candlestick pattern. Then once I get that, I'll be looking to short this market. So that's only going to be my scenario for shorting. You know, the market works in probabilities. You can't really say this is going to be what is happening, because even though the markets have been in an uptrend, there has been signs of weakness from the market. And when you see signs of weakness, you think in probabilities that, okay, if this happens, this is what I'm going to do, this happens, this is what I'm going to do. But what is giving me the doubt or the two-sided view about the market is the fact that the market is at a demand zone which has been holding, which means that it could still hold and will push up, and the market is still trading above it, so which means a strong bias is valid. But just in case the demand zone does not hold and also the trend line does not hold, then we mean we are going to crash to the downside and we'll be targeting somewhere around this area of value. So the things I look out for is the trend. Then I will see within this trend, is there a sign that the market might go bearish? If there is a sign, then I look into directions, and if there is no signs, then I look probably into trading that trend strictly. So now, if I'm going to be going long, I would be looking at this demand zone. You see, I'll be looking at a bullish candlestick formation that will be showing me the market is about to push up around this area. And also, one of the things I could also do is to get a counter trend line. A counter trend line break could be, so you can see, if I put this trend line here, you'll see that it pretty much looks like a triangle. So if the triangle breaks, if I get the break out of this triangle, then I'll be something like this. Then I'll be longing and I'll be targeting the highs of this particular area. So that's going to be my scenario for going long. I could just put my stop loss a little bit below here and target this high probably. And the reason why I'll be targeting that high is because the market is still not showing a big sign of trend, which might tell us that, okay, the market is an uptrend, but a reversal might come back anytime soon. And if you see the high time frame, you see that the high time frame is also showing a sign of weakness. So that is how I look into the market. So when I want to enter a trade, I look at the trend, I look at areas of value, area of conferences, area of interest. Then I look for support and resistance, areas of demand and supply. What is happening is the market at an integral part where the market has always respected in the past, and which the market is likely going to respect again. I look for candlestick patterns formation. When I see candlestick pattern formation, sometimes I hop in the market when I see a very strong candlestick, and sometimes I wait for more confirmation like the counter trend line break and some other things. Also, so let's also look at this Euro USD chart. This is a 1 hour time frame. Let's look at the Euro USD chart. I have a lot of analysis on Euro USD. The market is bullish, looking at this bullish movement from this area of value. So this is a strong level for Euro USD, where the market has pushed up after forming something that looks like a Morningstar candlestick pattern. The market has been bullish up to this zone, and my overall target for this market for now is this area of value. So now let's switch to the lower time frame and see if we could get potential in opportunities. So here is this. The market has been bullish right from this zone. We've had a series of higher highs, higher lows, higher highs, higher lows, higher highs. So the market gave an equal low here, came back again to this demand, higher highs, higher lows, higher highs, higher low. Right? So from this point, we are expecting the market to give us a higher high, and looking closely at this area, you would see that there is a point of interest around this zone. So this market is bullish and I'm bullish also, but I won't be buying until probably the market slips into this zone. So I would want the market to slip into this zone, something like this, come into this zone, maybe have a little bit of consolidation before going up. So one of the criteria I look at into when entering the market is also consolidation. Sometimes when market comes to an area and it starts consolidating, you need to be patient, because some of the things that happen is that when market comes to demand zone, sometimes it consolidates a little bit and maybe come a little bit below that demand zone, just to shake out some people that are entering as early as possible without looking for more confirmation. So in this kind of scenario, I'll be targeting this area once again, and I'll be looking for maybe a little bit of consolidation like a W pattern and a breakout of that before entering. So entering the market as a trader requires some confirmation. It requires that you have some strategies around it. Sometimes some people use the Fibonacci retracement, some people use different kind of strategy. But as far as I'm concerned, I use candlestick a lot. Candlestick confirmation, 4-hour confirmation, counter trend line break, and also when trading candlestick, another thing I look at when trading candlestick is the momentum of the candlestick. If the market breaks out of an area with a big momentum, with a very strong momentum, maybe the market is breaking out of a support or resistance with a very strong momentum, sometimes I get into the market immediately because of the number of orders in that, and that's what we call order block. So order block is also a concept that I used to enter the market, but I will not be talking about that for the sake of this video, because it's more of like a beginner video. If I bring the order block concept into this area, it might be a little bit difficult to understand. So candlestick is like enough for you as a trader, as a beginner trader, to enter the market. You just have to be able to confirm that the candlestick has momentum, and maybe if you are not sure enough, you can draw a counter trend line or use chart pattern like triangle, the breakout of the triangle, and retest to enter the trade.
If you have watched this video to this part, you are absolutely amazing. It's been a long ride, and I'm very sure you got value from every part of this video. If there is something in this video that you don't understand, ensure you leave a comment for me in the comment section so that I can make subsequent videos explaining some other parts or going into more details on some other parts of this video that you may not understand. And also, if you got value, don't forget to hit the like button and subscribe to my YouTube channel so that you get to see more content like this. I hope you got value from this video. I hope you love it. I hope you enjoy it. But also, if you love to learn more about advanced technical analysis like smart money concepts, Fibonacci trading, and all other advanced concepts, I'll implore you to get my 10x cryptocurrency mastermind course. The 10x cryptocurrency mastermind course is a detailed course and a mentorship program which teaches you how to trade the cryptocurrency market from the scratch. You learn every single detail you need before you get into cryptocurrency trading. Then you learn technical analysis, which is more advanced than what we have covered in this video, and you learn fundamental analysis of cryptocurrency market, how to profit in bull and the bear market, and also you get access, by getting this course or mentorship program, you get access to my community, my signal room that has a lot of students who have profitably made a lot of money from the cryptocurrency market. If this sounds right to you, and if you love to make a lot of money from the cryptocurrency market, consider getting the course. You'll find a link in the description below or somewhere around this video, and you get that.